Hi everyone, this is Martin from LRK Tax. Hope everyone's doing well. I wanted to create this video because our firm thought there were 10 key points that every employer needed to know about the updated new CEWS subsidies. So in this particular video, we'll go over these 10 particular key points as well as some real life examples to show how these rules are implemented in practice. Furthermore, we'll illustrate some of the resources and calculators that we have on our website to help us and you calculate these subsidies, because the subsidies under this new legislation is much more complex and much more complicated than the original subsidy. So 1, the CEWS has been extended until December of 2020. So here is a summary table of the relevant qualifying periods, the dates, and the current reference period. So when you go online and you look at CRA's website and they refer to period 1, 2, 3, 5, 6, 7, 10, this is what they're referring to. With the original CEWS, there were only a total of 4 periods. Now, the new legislation, there are a total of 10 periods. So when they're referring to period 1, they're referring to this date range and this particular month that they'll be looking for revenue decline in. So as an example, let's just say someone's referring to period 5. You would go, okay, period 5. I would want to know the salaries paid between July 5th to August 1st of 2020. And if I had a sufficient revenue decline in this particular month, July of 2020, then these wages would be subsidized in some way. And so that's really how you read this table. Qualifying period, you need to know the dates and the reference period for the revenue test. So 2, the CEWS is no longer an all or nothing subsidy. So with the original CEWS, what happened was you needed to meet a 30% revenue decline test to get a 75% wage subsidy. If you had 29% revenue decline, then you wouldn't get anything. With this new subsidy, the way it works is that you still need a revenue decline, but if you have at least some revenue decline, you'll still get something. So businesses with less than 30% revenue decline, they'll still get something from the government. And this is way more beneficial to a lot more businesses, such as, this particular guy here, whose head's a little bit too small for his body, but he doesn't care because probably he was a business who didn't have a 30% revenue decline. He might have had a 25 or 20% revenue decline test. And now he's eligible to get something. So 3, the CEWS program is now split up into 2 subsidies, the base subsidy and the top-up subsidy. So the base subsidy is a little bit more similar to what the original CEWS subsidy was. It's slightly modified to take into account that there are businesses that have revenue decline of less than 30%, but more than 0%. And then there's a second subsidy, which is the top-up subsidy. This is for those businesses who have a revenue decline of greater than 50%. So what happens is the new subsidy, the CEWS subsidy, consists of both these 2 subsidies in aggregate. So the base subsidy, to understand the base subsidy, we created a little bit of a table to hopefully clarify how all this works. Again, you want to look at the periods that you're in. This new base subsidy and this new top-up subsidy and pretty much the new CEWS program is effective period 5 onwards. So again, we've described period 5. You look at the dates you're paying the wages in that particular period. So using period 5 as an example, you look at the wages paid between July 5th to August 1st. And the next row is pretty self-explanatory. It is the maximum weekly benefit per employee. So in period 5, the maximum weekly benefit that you can get using the base subsidy is $677. So you notice as you get further and further along into the CEWS program, the amount of the weekly maximum benefit per employee decreases all the way down to $226. Moving down to the row below, you calculate your revenue decline as usual. And if you realize that your revenue decline is more than 50%, you'll take these percentages and apply it to the wages that you paid in these periods. So what happens is, if you have a revenue drop of 51% for this period, you'll take your wages paid between in this period, multiply by 60%, and that is your base subsidy. Gets a little bit more complicated when you have a revenue drop of 0% to 49%. Obviously, this rule will no longer be applicable. You have to calculate a new subsidy percentage. And so the way it works is they have a fixed multiplier. So for period 5, the multiplier is 1.2. Same for period 6. You'll notice it starts decreasing as you get further along into the CEWS program, kind of like the weekly maximum benefit per employee. So you take your multiplier and you'll multiply it by your revenue drop percentage to get your reimbursement percentage. So in this particular case, we'll use a revenue drop of 20%. So 20% times your multiplier 1.2 is 24%, meaning that rather than getting 60% reimbursement, you're only going to get a 24% reimbursement rate. At the other end of the spectrum, as you get to the end of the CEWS program, so your multiplier is 0.4. Again, assuming a 20% revenue drop, you are looking at an 8% reimbursement rate for the wages paid in this period. So this is how you calculate the base subsidy. First thing is, as usual, look at which period you're in, the wages you're in. The wages that you're paying in that particular period. Because depending on the period, you'll have certain maximum employee entitlements as well as certain reimbursement percentages. Once you've calculated how much of a revenue decline you have, you want to determine if it's more than 50%. If it's more than 50%, you just apply these percentages. That's all you do. If you're below 50%, you apply this multiplier concept times the revenue drop. So one additional key point about the base subsidy. There is something known as the safe harbor rule for periods 5 and 6. What this is, it's really a fancy term to let employers choose to calculate the CEWS under the old rules versus the new rules. And the reason is, under the old rules, if you have a 30% decline, you get a 75% wage subsidy, which is obviously a lot better than a 60% wage subsidy, even if you have a revenue decline of more than 50%. So that's something to keep in mind, that for periods 5 and 6, you can choose to calculate it under the old CEWS method. So 4, CEWS for furloughed employees. So for periods 5 and after, the CEWS for furloughed employees, those guys, you are still employed, but they're on leave with pay. They would be eligible for this new CEWS program where you get the base subsidy and the top-up subsidy. But for periods 4 and 5, as long as the revenue decline is greater than 0%, the employees will qualify for the 75% original wage subsidy program. And there is no need to meet a revenue decline of 30% in periods 4 and 5. As long as revenue decline is more than 0, eligible employers can qualify for CEWS for the furloughed employees. When you're calculating the furlough employee wage subsidy, it's going to be the same as periods 1 to 4. You have the arm's length employee test, and you have a minimum test here as well. So nothing really changes. I'm not going to go too much in depth into that. Moving on, we've got our little guy here, our furloughed employee who's unshaven and chilling at home watching Netflix. He is going to be happy because, with this particular legislation, I think it's really intended to kind of give them more certainty as to their compensation. And also, obviously, it ties them back to the employer, getting them away from the CERB. So with the CERB, again, there's more certainty. With the wage subsidy, there isn't. So for the government's objective of getting people back onto the payroll, getting back related to involved in the workforce, this provides a little bit more stability. There's no concrete rules at this particular time, but again, it's going to come soon. 5, Changes to the baseline remuneration calculation. So this concept of baseline remuneration, it's also known as pre-crisis earnings, especially important for a lot of our clients, such as owner managers, as owner managers are generally not at arm's length with the employer, which is generally the corporation that they control. And so what the government doesn't want to happen is for the owner manager to all of a sudden jack up their compensation in hopes of getting it subsidized. And so with the original CEWS program, they said, look, take your wages from January 1st to March 15th. The weekly average for this period will be your baseline remuneration. And so, with the original CEWS, the CEWS subsidy will take the baseline remuneration as a limiting factor. And with the new CEWS, the only thing that really changed is the periods. Before, for periods 1 to 3, the automatic treatment was you have to look at the wages that you paid from January 1st to March 15th. Now, with the new CEWS subsidy program, you can now look at March 1st, 2019 to May 31st, 2019 as your baseline. So, for example, let's just say if you're an owner manager and you paid yourself nothing from January 1st to March 15th, then you would have no baseline, which is not a good thing. But suppose you paid yourself from March 1st, 2019 to May 31st, 2019, you can now compute your baseline remuneration for this period, which is, again, a lot better because for owner managers and other applications, you need baseline remuneration to compute the CEWS subsidy. So for period 4, same thing. You would have your January 1st to March 15th as your default baseline remuneration period, but you can choose other periods, especially if you paid more in these particular periods. Same thing for period 5 and subsequent periods. January 1st to March 15th, default period. But if you found out you paid yourself more, July 1st to December 31st, then you can use that particular period. 6. Using same revenue decline percentage in subsequent period. So with the old rules, what happened was there was a rule which allowed an employer to be automatically eligible for the CEWS, provided they were eligible in the previous period. So if I was eligible in period 1, I would be automatically be eligible for period 2. So that's how the old CEWS program works. So in this particular case, with the new CEWS legislation, there's actually an improved mechanism in place. So what it does is that for periods 5 and after, you would basically be able to use the higher of the revenue decline percentage in the current period or in the previous period. So let's just say arbitrarily I use period 6, right? So in period 6, I had a revenue decline of 65% and a 45% decline in period 7. What this new rule allows me to do is basically use the 65% revenue decline for both periods 6 and 7. And this is way superior to the old rule just because now the name of the game isn't just to qualify, it's to qualify with the biggest revenue decline, because with the way the CEWS works now is that the higher revenue decline, the higher your subsidy. So again, if it was under the old rules, let's just say I automatically qualify period 7. I mean, I would be calculating my CEWS using a 45% revenue decline. So this mechanism allowing me to use both 65% and both period 6 and 7 is far superior than the old rules, and it basically provides a superior result, which should lead to a greater CEWS subsidy for people taking advantage of this rule. 7. Changes to the prior reference periods for the revenue test. So with the old CEWS subsidy, what happened was employers would basically pick a particular month in 2020 and compare it to the same month in 2019 to determine how big of a revenue decline there was. That was known as the general approach. Now, under the old rules, there was something also known as the alternative approach. Again, the employer would pick a particular month in 2020, but rather than comparing it to the same month in 2019, they would compare their revenue decline based on the revenues from January to February, and it's going to be the average of January and February of 2020. And this is known as the alternative approach. What happened was, under the old rules, you were not allowed to flip-flop. So basically, once you've picked an approach, it basically you're pretty much locked in. So you can't say one period I'm going to use the year over year, the next period I'm going to use the average of. So pretty much once you pick one, it's locked in. With the new legislation, what happens is you're now allowed to kind of reset. So what happens is, for the first 4 periods, the choice that you've made is locked in. But for period 5, you can now choose again to take either the general approach, which is the year over year, or the alternative approach, which is to compare the specific 2020 month to the January and February 2020 average revenue to compute your revenue decline. Just like the first CEWS, once you've picked a particular methodology for period 5, you're locked in, so you can't flip-flop. So basically, this particular rule just allows you kind of reset. It gives you another a choice for period 5 again. 8. The application period has been extended. Before, with the old legislation, everything had to get done before October 2020. Now the CEWS application period has been extended to February 2021, meaning that everything has to get done by January 31st, 2021. So good news all around, clients, as well as for us. Certainly for more high fives, good big thumbs up. Anytime deadlines get pushed back, it's always good news for us. 9. Election to use the accrual method of computing revenue. So under the old rules, what happened was, businesses that generally compute their revenues using the accrual method were specifically permitted to compute the revenues under the cash method. And so this particular piece of legislation is really to clarify that for those businesses who use the cash method of computing the revenues, they're allowed to elect to use the accrual method. And there's a little more of a clarification. And obviously it really depends on which method gives you the desired revenues, especially, if you have one method that gives you so much money, you've got like money spilling out of your wallet and it's bigger than you, then you might want to choose that particular method to compute your revenue decline. So it just basically gives the option to the person who's using the cash method to go use the accrual method, and it just clarifies that. 10. Purchase businesses with no history. So with whether you're calculating your CEWS subsidy under the old legislation or the new legislation, one crucial thing you need is the decline in revenue. But if you purchased a business and you don't have a history, for example, if you weren't in existence in 2019, or if you weren't in existence in January, February of 2020, you may have nothing to compare it against. So there's a new rule in place that says for purchase businesses, meaning that if you've bought substantially all of the assets of a business, you can use the seller who sold you the assets. You can use their revenues in 2019 to compute your revenue decline. It's a little bit of an interesting, complicated area. I won't get too much into it, but one restriction is that the seller cannot double count, meaning that they cannot apply for the CEWS using their 2019 revenues and also allow you to use their revenues to calculate your CEWS. Now, most cases, once the seller sold their businesses, presumably they wouldn't be applying for the CEWS, but there might be in some limited cases where, a seller might have multiple lines of businesses and they might still calculate the CEWS. So it's a very interesting and peculiar topic. We just want to point out that if you did buy a business, it's not a guarantee that you won't get the CEWS. There are ways to get it. So before we get to the examples, just really want to briefly touch upon the rules that remain unchanged in case there was any uncertainty. So no significant changes to eligible remuneration, eligible employer, eligible employee, and generally no changes to the computation of revenues. So there you have it, the top 10 things every employer needs to know about the new CEWS subsidy. We're going to do a part 2 where we outline some real life examples and also show how to use our new calculator. As always, all our resources are on our website, so check us out, www.lrktax.ca. Okay, take care, everyone.